and welcome to the 43rd edition of Marex Maritime News.
The central government of India has decided to regulate freight charges levied by shipping firms for export, import and local transportation in a move that is bound to run into opposition from carriers. The plan to regulate freight charges is one of the new provisions in the draft Merchant Shipping Bill 2020.
While the intention behind the introduction of the Merchant Shipping Bill 2020 may be good, if enacted in its present form, it could perhaps have some serious consequences as far as the trade is concerned. For instance, during the pre-containerization era, the shipping lines essentially charged just the ocean freight, while the shippers and the consignees took care of the landside costs. With the advent of containerization, this changed because the ports and the other agencies started billing the shipping lines for the landside costs as well. And obviously these costs got incorporated into the ocean freight. Sometime during the 1990s, for the sake of transparency, the shippers and the consignees requested the lines to segregate these costs from the ocean freight so that there could be two separate components. One is the ocean freight and the other is of these charges, and this would create more transparency, of course. However, what the Merchant Shipping Bill currently states or suggests is that these charges should be consolidated along with the ocean freight. If that happens, we'll be going back to the olden days where transparency was really a question, and this could make matters worse. As far as the GST itself is concerned, the government could stand to lose about 3,424 crores annually in terms of GST if this bill is enacted. Currently, on export freight, there is no GST. On import freight, 5% GST is payable. And on surcharges, 18% GST is chargeable. If these surcharges get included into the ocean freight, the government would stand to lose all this GST that's currently collecting. Also, as far as the rate contracts themselves are concerned, the shippers and the consignees might not really want the confidential rate contracts with the shipping lines to be made visible to their competitors, as these would be incorporated on the bills of lading, which pass through several agencies, and the information could perhaps be then visible to their competitors. This would be even more sensitive in the case where foreign buyers or sellers are paying the freight. 40% of Indian exports and 80% of Indian imports could thus be impacted. Also, consolidation of surcharges with the ocean freight would make Incoterms non-compliant. Besides, how do the shipping lines know at the time of the release of the BL that certain charges would be payable? For instance, there are incidental charges like container detention or container repair charges which could happen or not happen at the end of the transaction. However, if the trade feels that for the sake of transparency, they need the surcharges to be mentioned on the bills of lading, the shipping lines could possibly consider this. Freight rates, though, cannot be included or brought under the purview of the Merchant Shipping Bill, as this would interfere with the commercial terms between the shippers and the shippers' consignees and the shipping line. We hope that the government takes all these factors into account before enacting this bill.
These are the headlines on Monday, 7th December 2020. 2021 shipping forecast, stable with less volatile freight rates. Indian Navy's aircraft carrier successfully completes basin trials. New building orders continue to dwindle. WIMCO urges EU to approve ship recycling in India.
Chogles manage largest cargo ship to berth at Vizag.
Fitch Ratings has revised its global shipping sector outlook to stable, reflecting improving fundamentals for the container shipping and dry bulk, but a relatively weak tanker segment. Prudent capacity management, particularly in container shipping, could enable operators to benefit from a partial rebound in demand across freight categories in 2021, based on the current expectations for a global economic recovery. However, there could be a higher than average intra-year volatility due to timing mismatch. Key downside risks include slower economic recovery than forecast or coronavirus pandemic waves that could lead to a collapse in demand comparable to the second quarter in 2020.
Finally, we are seeing light at the end of the tunnel. However, I do hope that our seafarers are high up in the priority list for vaccinations, because they are the ones who are going to take us to 2021, where we do expect freight markets to get better. Shipping is a derived demand. Yes, the demand for ships comes from demand for trade. However, the freight rates are a function not only of demand, but also of supply. So far, the supply is in the elastic zone, that is, the curve is horizontal. It doesn't matter how much demand increases, because freight rates are not going to increase. It's only when the supply line becomes inelastic, lack of ships, or very few ships, then we see the demand for ships go up, the freight rates go up. Are we seeing that? Yes, structurally, the order book is very thin. And if you look at the virtual shortage for ships, is because of the slow steaming. When the freight rates go up, there is likelihood that people will start speeding up their ships. Now, what is happening from the trade side? If you look at the commodities, the price for the commodities for the last few months has been going up. Copper is one of the lead indicators of good days to come. And if we see copper prices are going up, iron ore is going up, coking coal prices are going up, it means the steel prices are going to go up, even though they are showing a little bit of backwardation from today's price to Q3, Q4 next year. I do feel that the markets are going to get better considering all these factors. There are some negative sides, of course. The uncertainty is something which is to be remembered. Volatility will definitely be there. Larger the size of the ship, higher the wall. For the Cape size, the wall could be almost as 190%, 200%, and the smaller size has less wall. But anyway, that's what shipping is all about. So I'm quite positive from lows in the market where we are starting. Q1 may be bad, not so good rather next year, but after that, we are going to see the market will continue to improve.
To hope or predict that freight market will be stable is, in simple language, wishful thinking. Rich will be a commentator or a forecaster who can call it right, given the vagaries of the market, especially shipping freight market, that is a derived demand driven by so many variables: politics, economics, weather, natural calamities, trade barriers, things like that. Anyway, leaving the micro, looking at the current scenario, COVID and after, there is definitely a need or opportunity to catch up with pent-up demand. And what we have seen in the past is pent-up demand economically can create mayhem in the market. Because if you see the market going up, right down to design shipbuilding, everything starts moving up. And when the pent-up demand dies, sort of flattens, the supply side is on the higher side. This has been very cyclical. This will continue. I don't know, even with artificial intelligence, if we can really forecast anything useful. But the players in the market, the investors, I believe, are the least informed because they are punting.
In a positive development, the basin trials of the Indian Navy's upcoming indigenous aircraft carrier was successfully conducted at the Cochin Shipyard Limited on Monday, 30th November. The basin trials were carried out in presence of Vice Admiral A.K. Chawla, Flag Officer Commanding-in-Chief, Southern Naval Command, and Shri Madhu S. Nair, Chairman and Managing Director, CSL. With the basin trials accomplished, the carrier has now entered the final phase of development. The carrier is now likely to undergo sea trials in the first half of 2021. New buildings orders have continued to dwindle as ship owners continue to opt to add to their fleet rather than commission more new buildings. As a result, more deals have started to materialize in the S&P market. In their latest weekly report, shipbroker Aligned Shipbroking has said that on the dry bulk side, the positive momentum in the fleet earnings and the current supply-demand fundamentals has, as a result, the intensification of interest among buyers as of late. On the tanker side, it seems that the considerable activity noted a week prior was not a sole event, as the buying appetite has started to revive amongst expectations for a more healthier market in 2021.
The road ahead is brighter but challenging. Performance would differ markedly across the main economies. Heterogeneity in developments in the major economies is set to persist, both between advanced and emerging market economies. The economic impact of the pandemic has been relatively well contained in Asia Pacific and Northern European economies. On the contrary, the measures required to control virus outbreaks in other parts of Europe and other emerging market economies have been prolonged and involve much deeper declines in output. Shipyards are hungry for business, no doubt, and the best way to attract attention is by competitive pricing. A combination of historically low prices and moving closer to beating COVID-19 may be behind a pickup in ordering. A lot of Chinese companies are ordering in Chinese shipyards, for example. It will be one thing to roll out vaccines and develop herd immunity, and quite another to deal with the colossal economic damage and mental health issues caused by voluntarily locking down society. Nonetheless, markets, whether stock, commodities, or shipping, like the idea of a rapid snapback in demand from a low base, even if it will be a miracle if we get back to end 2019 demand levels by end 2021. In shipping, we have witnessed spikes in all three main sectors and can expect more of the same in 2021 when net fleet supply growth should begin. The companies that are moving on new buildings tend to be in large state actors, financial investors, and the wealthiest private ship owners. They all have access to money from taxpayers like you and me, other people, equity and debt capital markets, and even their own cash. Most ship owners exist outside this club and prefer to focus upon second-hand purchases, given less access to cash and bank loans. Also, one could argue, good deals are available in the existing fleet, giving delivery within months rather than years, gaining crucial exposure to better markets that lie ahead in 2021-23. With Asian markets booming, empty boxes are piling up in destination countries while carriers are dashing back to Asia with empties. It could take months to sort this out. China aims to carry 50% of all its seaborne imports and exports on Chinese hulls. Imagine if India did the same, but maybe not when you count COSCO's fleet of 961 vessels versus SCI's 133. 35 VLCCs were ordered in 2019, 50 in 2018, and 56 in 2017. So far, the firm VLCC order book is at 34 this year, one short of last year at around $89 million each. It shows how quickly the order pipeline can balloon when state actors are involved. VLCC units either side of 20 years of age have fetched as much as $25 million from obscure buyers intending to trade sanctions-bound Iranian and Venezuelan crude, as opposed to getting only about $15 million in the demolition market. Only one VLCC has been scrapped this year after 4 in 2019, 31 in 2018, and 13 in 2017. There is significant congestion in multiple ports in China at present, which we must remember. The very large ore carrier Gala Celeris, 229,000 deadweight 2006 build, is reported to have sold for $12 million. It is not often we see VLOCC change hand in the second-hand market, and it is interesting to see how significantly she has been discounted to the same age Newcastle Max Sen Oku 206,000 deadweight 2006 build, which reportedly fetched $15 million last week. In the short term, COVID-19 restrictions are denting oil demand. In the long term, the world's major economies are recommitting to tougher decarbonizing schedules. So while the bulk and container markets are off to the ball, the tankers remain in the Cinderella role. We wait to see how quickly the vaccination program can take up the role of fairy godmother, restoring confidence and demand.
And now, the news in detail.
The next step is now definitely there has been some pressure on Indian jobs in one way or another.
Indian Maritime University, a central university under Ministry of Shipping, Government of India.
Indian scrap yards have improved their conditions so much that they should now be approved for the use by the EU and be added to the list of international scrap yards that are allowed to scrap European vessels, said BIMCO. However, EU inspectors dismissed 6 Indian scrap yards just this year. But the international capacity at shipyards for recycling and scrapping of older vessels is too limited, thinks shipping organization BIMCO. The Indian shipping service provider and part of the Chogle Group, Chogle Brothers, recently announced the successful management of W Oslo, the largest cargo ship to be handled at the inner harbour of Visakhapatnam port. The port of Visakhapatnam created a record by handling this vessel. The W Oslo was carrying 87,529 tons of steam coal from Richards Bay, South Africa for Sarda Metal and Alloys. Stay safe, stay healthy. Thank you for watching. See you all next Monday.